Well, there's been a lot of talk lately about China cutting off silver, London running out of metal, and silver being one headline away from a massive move higher. So in this video, we're going to separate what is actually happening from what sounds exciting on the surface, and you are going to walk away with a much clearer view of the silver market than most people screaming about it online. Today is Monday, April 27th, New York time, and before we get into it, comment what day and date you're watching from, because with a market this volatile, the date you hear the analysis matters almost as much as the analysis itself. And real quick, if you value this kind of work, subscribe and comment John A.G. Best below. That tells me you want original research, not recycled fear. So the claim going around is simple. China used to supply a lot of silver to the world. Then it allegedly stopped, industrial demand kept rising, Asian buyers started paying premiums, London got tight, and now silver has no choice but to explode. Okay, that is the surface version. But the surface version is not enough, because when you take this apart piece by piece, you find something more interesting than the headline. You find that the silver market is tight, yes. You find that China matters, yes. You find that industrial demand is real, yes. But you also find that some of the loudest claims are too clean, too absolute, and a little too convenient. Let me show you what I mean. First, the China export story. The viral version says China went from being a major supplier to exporting nothing. And if that were literally true across the whole refined silver market, that would be a very big deal. However, recent market updates show China still naming companies allowed to export silver over the next cycle, and the number of approved silver exporters was actually slightly higher than before. So right away, we have a problem with the word nothing. Now, does that mean China is not controlling the flow? No. It means the situation is more nuanced. China can still export silver and at the same time treat silver as a strategic resource. Those two things can both be true. Think about it like a faucet. The faucet does not need to be turned completely off to change the pressure in the room. If the flow slows, if approvals tighten, if domestic buyers get priority, or if exporters become more cautious, the global market can feel that pressure even without a total cutoff. And this is where the story becomes important. Silver was added to the United States critical minerals list, which means it is now being viewed through a national security and supply chain lens, not just as jewelry, coins, and industrial feedstock. That does not automatically mean panic. But it does mean silver is moving into the same conversation as minerals that governments do not want to leave entirely to market luck. That is the first key point. Silver is no longer only a commodity story. It is becoming a strategic material story. Now, why does that matter? Because silver is not easy to replace. It has the highest electrical conductivity of any metal, very high reflectivity, strong thermal performance, and a long history as a monetary metal. That combination is rare. You can thrift it. You can reduce the amount used per solar cell. You can redesign parts, but you cannot simply wake up tomorrow and pretend silver is aluminum. This is why the industrial side really matters so much. Solar panels use silver. Electronics use silver. Electric vehicles, grid equipment, medical products, catalysts, defense applications, and data centers all touch silver in different ways. Some uses are small per unit, but when the unit count becomes huge, small becomes meaningful. Based on recently published numbers, the silver market is heading into another annual deficit, and above-ground inventories have already been drawn down by a very large amount since the beginning of this decade. So when people say, "Where is the shortage?" the answer is not always one empty vault. Sometimes the answer is years of small deficits quietly eating the cushion, and this is what most casual viewers miss. A shortage does not always announce itself with a locked warehouse and a flashing red light. Sometimes it appears first as higher lease rates, odd premiums, slower settlement, more metal moving by air, and sudden confusion over which location actually has deliverable bars. That is what happened in London. Lease rates jumped to extreme levels during the squeeze, then later eased as metal moved back and liquidity improved. So yes, the stress was real. But no, it did not mean silver permanently disappeared. It meant the market had a location problem, a liquidity problem, and a timing problem. And those problems matter. Imagine there is plenty of water in the country, but the city you are standing in has a pipe break. Someone far away says, "There is no water shortage." You say, "Okay, then why can't I fill a glass?" Both people can be telling the truth, but only one person is thirsty. That is silver. There can be metal somewhere, and still not enough metal in the right vault, in the right form, at the right moment. Now, let's talk about the demand side, because this is where the bulls have their strongest case. China's solar exports recently hit a record monthly level, helped by energy security concerns, price changes, and demand from fast-growing regions. That matters because solar is one of the biggest industrial silver stories of this decade. But here is the part that gets left out. High silver prices also force manufacturers to use less silver per panel, and recent forecasts show photovoltaic demand can fall even while solar installations keep rising. So if someone tells you solar demand only goes up in a straight line, be careful. That is not how manufacturing works. When input costs become painful, engineers get creative. They thrift, they substitute, they redesign, they pressure suppliers, and eventually the demand curve bends. This is not bearish, it is just real. The same thing happens with jewelry and silverware. When prices run too far too fast, buyers step back. Some people sell old silver. Recycling improves. Scrap supply comes out of drawers, temples, family collections, and industrial waste streams. That does not solve everything, but it does soften the blow. And that is why the deficit estimates vary so much. One estimate may focus on physical investment recovering, another may assume industrial demand weakens, another may count inventory releases differently. So when one analyst says the deficit is huge, and another says the deficit is smaller, it does not always mean one of them is lying. It may mean they are measuring different bathtubs. This is the same mistake people make in almost every silver panic. They look at one number, treat it like the whole market, and then build a price target on top of it. But silver has mine supply, recycling, investment bars, exchange inventories, exchange-traded products, industrial fabrication, imports, exports, leasing, and private hoards all moving at once. If you only look at one stream of water, you miss the bathtub. Now, to be fair, silver does have a setup that can move violently. It is a small market compared with gold. Investment demand can arrive suddenly. Industrial users cannot always wait. And if investors start pulling metal into long-term storage at the same time manufacturers need immediate supply, the paper price can move faster than normal models expect. That is the bullish case. But there is also a counterpoint. The market already showed us how dangerous a straight-line silver rally can be. Silver hit record levels, then dropped hard after technical selling and stop-loss pressure turned into a snowball. That does not mean the long-term story is dead. It means leverage can turn a good thesis into a bad trade. This is why I do not like the phrase unstoppable. In markets, almost nothing is unstoppable. A squeeze can be real and still reverse. A deficit can be real and still get rationed by price. A strategic metal can be important and still punish late buyers. So what should we actually watch? First, watch China, but not just the headline. Watch export licenses, actual shipments, import demand, and whether domestic users appear to get priority. If China keeps importing aggressively while export channels remain controlled, that is more important than any viral post. Second, watch London. Not rumors. Liquidity. Lease rates. Available stock. Metal not tied to exchange-traded products. If the free float tightens again, the squeeze risk comes back. Third, watch Shanghai and India premiums. Premiums tell you where physical demand is urgent. But do not forget taxes, logistics, and local rules. A premium is a clue, not a final verdict. Fourth, watch solar thrifting. If silver use per panel keeps falling, industrial demand becomes less explosive than the bulls want. If thrifting slows and installations keep rising, then the pressure comes back. Fifth, watch investment demand. This is the wild card. Industrial demand is slow and measurable. Investment demand is emotional. It can be asleep for years, then wake up in one quarter. And if you are successful, share your success story in the comments so others can stay motivated. A lot of people watching are trying to learn how to stay calm in a market designed to make them emotional. One more piece matters here, and it is mine supply. Silver production does not behave like a faucet either. A lot of silver comes as a byproduct from mines that are mainly producing copper, lead, zinc, or gold. So even if silver price jumps, the world cannot instantly double silver output because the mine plan is often driven by another metal. That makes the upside response slower than people expect. Recycling helps, but recycling has its own bottlenecks. Someone may want to sell old silverware when prices rise, but that metal still has to be collected, refined, assayed, transported, and turned into the form industrial users actually need. So yes, high prices bring supply, but they do not bring perfect supply overnight. And this is why I keep coming back to timing. A market can have enough metal over a year, but not enough metal over a week. That window is where squeezes are born, not because every ounce vanished, but because buyers need specific ounces immediately. There is also a policy angle. When governments start labeling materials as critical, companies start changing behavior before bans arrive. They build buffers, they diversify suppliers, they sign longer contracts. They pay more for reliability. That kind of quiet hoarding does not always show up in headlines, but it tightens the market. So the story is not just China. It is China plus policy, China plus solar, China plus savings, China plus London liquidity, and China plus a Western market that waited too long to ask where its physical metal really comes from. Now, let's widen this out. Silver is not trading in a calm world. Energy routes have been disrupted. Clean energy exports are rising partly because countries are thinking harder about energy security. Chinese household deposits are enormous, and as deposit rates get repriced lower, savers have more reason to look for alternatives. Some will choose deposits anyway. Some will choose stocks. Some will choose property. But some will choose gold and silver. That does not mean every Chinese saver is buying silver bars tomorrow. It means the pool of potential demand is large enough that small shifts can matter. And this is where Asia becomes important. In the West, silver is often treated like gold's little brother. In parts of Asia, silver still carries a deeper monetary memory. People may not talk about it in academic terms, but they understand the idea of holding something outside the banking system. So when you combine industrial demand, strategic classification, China's role in exports, Asian savings behavior, and tight physical liquidity, you get a market that can surprise people. But notice what I did not say. I did not say silver must go to $300 because one chart says so. That is not analysis. That is a headline dressed up as certainty. Could silver go dramatically higher in a true physical squeeze? Yes. Could it overshoot in a mania? Definitely. Could it also drop sharply after that because industry reduces consumption, investors take profits, and liquidity returns? Also, yes. So the smarter question is not, what is the biggest number I can imagine? The smarter question is, what conditions would make that number possible? For a massive silver move, you would need several things happening together. You would need physical stress in London or another major hub. You would need investment demand to stay strong instead of flipping into profit-taking. You would need industrial buyers to keep absorbing metal despite high prices. You would need China to remain more buyer than supplier. And you would need macro fear to keep supporting precious metals broadly. If those pieces align, silver can move violently. If only one or two pieces align, the move can still happen, but it may be shorter, messier, and more painful for anyone chasing late. That is the part nobody wants to hear, but it is the part that protects you. So putting this all together, is the silver market tight? Yes. Is China important? Absolutely. Is the critical minerals angle real? Yes. Are physical market stresses worth watching? Definitely. But is the simple headline, China cut off all silver supply, therefore a massive spike is guaranteed, the best way to understand the market? No, it is too simple. The better version is this. Silver is being repriced because the world is realizing it is both an industrial metal and a monetary hedge, while inventories are no longer as comfortable as people assumed. China did not need to shut every door for the market to feel pressure. It only needed to become more strategic about which doors stay open. And that is where we are. So here's my question for you. Do you think silver is in the early stage of a structural repricing? Or do you think this is another emotional squeeze that eventually cools off? Comment your answer below, because I want to see where this audience stands. And if this breakdown helped, subscribe before the next update. Silver is moving fast, and the next important clue probably will not arrive with a warning label. This is for education only. I am not your financial advisor, and I am not telling you to buy, sell, or hold silver. I am showing you how I would separate a real market signal from a loud market story, so you can make your own decision without getting pulled around by fear, hype, or somebody else's price target.